Hi guys, so no lies, I'm under 40, obviously, and I was struck by a recent article in the newspaper around 5 investment funds we should buy if we were under 40. First of all, I was a little bit annoyed by the headline because, to be honest, in my own journey, I've learned that a no-nonsense and simple investing is the route to consistent returns. We don't need active investing at all and don't need to try and pick the best funds all the time. It's too much responsibility and stress. Passive investing has also shown that over time it beats active investors every single time. And also, why 5 funds? Why not 10 or 1? This arbitrary number is a little bit rubbish. But anyway, I didn't mean to start with it. When it does come to investing, you have to make the right choices at the beginning in picking passive diversified funds and be consistent, and your pot is guaranteed to grow. I don't care what people say, it has proven to work over the last 100 years and I don't see any reason it will stop. Pandemic has cemented that a little bit further, and for me, even through great economic turmoil, we do get through and good companies figure it out, and staying consistent allows concepts like dollar or pound cost averaging to work and irons out volatility and returns over the long run. It's all very nice, I'm not gonna lie. I actually did a video on dollar cost averaging, which you can see in a little bit more detail up here. Now, with that little preach over, I did discover some astonishing returns with active fund picking. It actually blew my mind, and my FOMO for just buying one fund and doing that forever kind of felt a little bit off. So there were some very good nuggets of information that would make a nice cornerstone for active picking of funds. So let's sprinkle the facts. Successful investing boils down to investing in the right products that fit our strategy and individual risk profile. Generally younger people with the bulk of our working years still in front of us, it is normally advised that we can take a little bit more risk with our portfolios. But that doesn't really mean go out and buy Bitcoin. But instead we can own more stocks, and actually if we want to take even more risk, buy stocks in emerging economies. But what does that mean? Small caps, high growth sectors, which right now are technology, blockchain technologies, cannabis, all of those where payoffs can be very nice indeed. But with age in mind and being under 40 myself, what are the gurus touting we should have allocations to? Let's summarize. First of all, they say allocate to global funds. So the cornerstone of our allocations and research should focus on funds that are targeting the best businesses in the world and those businesses that are targeting growth. Now, I do like this idea a lot and do it myself in my own fund where I invest in UK mid-cap growth companies. But which funds can you invest in that actually do this? Well, 2 that are being discussed right now are Scottish Mortgage and Edinburgh Worldwide, which are both run by Baillie Gifford, a Scottish investment firm, which were early investors in Tesla and Amazon. So they know about good catches. The ethos of the fund is to seek out innovative companies that are disrupting the status quo of their sectors. And the fund does this by looking across sectors and the globe itself. Something we as retail investors just could not sensibly do. I mean, there are some nuances to the funds. For instance, Edinburgh Worldwide has a higher allocation to small caps. Both funds have actually smashed the FTSE with over 10 times returns. Isn't that mad? So they're actually killing it. The second tip was to allocate to emerging markets. This is a good area of investing for younger investors. Buying companies in fast-growing economies in Latin America, Africa and Asia provides access to the beta of that market growth. It's also a source of innovation, and exciting companies emerge from these parts of the world. One fund to look at is the Templeton Emerging Markets Fund, which has delivered 135% in 5 years by investing in companies like Tencent, Alibaba, and the best recent investment being Naver, a South Korean search engine. Now, personally, I have tended to invest in India myself in the past with the Jupiter India Fund, which has delivered 40% in the last 12 months, but it was a bumpy ride, especially with the tragedy of the virus in the region. The third tip is buy British. Now, there is such a thing as home bias. Being in the UK and having UK jobs, UK homes, and contributing to the UK economy, we are massively exposed to the UK, which often results in us thinking we shouldn't really invest in UK stock and diversify out the UK. There is truth to that. But the UK right now presents massive opportunity, guys. It's the cheapest developed economy to buy stock in, and also an opportunity to earn multiples. And that's beginning to show up with investor interest. You have to remember that the UK economy has been getting battered since the Brexit vote, but the UK has been outperforming global rivals this year, and a trend that will actually pick up. If you look at the financial news, you will know all the private equity interest in the UK stocks because it's so cheap. Now, one fund I have owned in the past which focuses on this is the Marlborough Grow Special Sets Fund, which is still a good shout for smaller mid-cap UK exposure. I don't own the fund anymore as I tend to pick my own UK favourites now. So the question is, will I be switching to active funds? Probably not for the moment. Coping with toddlers, work and business takes enough time as it is, and all my spare time researching investment opportunities is taken up trying to pick 10 UK stocks per year. My plan is to keep buying my diversified global Vanguard fund, which, guess what, owns UK, the globe and small caps, and over the last decade would have more than doubled, actually almost tripled my money if I did start a decade ago. Now, with these three ideas, I have created a bunch of videos here that goes into why these funds still work. First, dollar cost averaging and why consistency allows compounding to work. It is a must watch, I'm not gonna lie. Also, a video I did last year about the strategies I'm using to retire before I turn 40. And the most recent video, which shows why the UK remains a hot investment area. So click right there and I'll see you over there. Cheers.